to the roundtable, everyone. I'm Tom Nunemaker with Jim Riggio. And before we get started, we have an interesting presentation on covered calls, but we do have a disclaimer to go over. The capital discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with the disclaimer out of the way, I will give you the ball, Jim. There you go.
Okay. And Tom, is there a way for me to share my alternate monitor?
Oh, probably. I'm only using one screen, so I haven't really delved into the two-screen thing here. I think it lets you pick which monitor, though, doesn't it?
Well, we'll try, and we'll see. If I pull this over to here, heads, come over to here. Options, manage panel, speakers view. Yeah, because I wanted to share the other screen is the way I kind of set it up.
We see the thanks for using WebEx.
Yeah, we don't want that one. We want the other one. Share. Share desktop. Okay. Well, I guess what we're going to have to end up doing is doing it this way then. Okay, let's bring it over here and do it this way. Unfortunately, I cannot end up saving this thing as and doing a full screen on it because I ended up, you know what? I can if I do this. Let me just take out the other monitor, and that will do it. Okay, you get a full screen that way. It's just now I just can't see what's going on the next page. Basically, this says the same thing that Tom just said. The one thing I do want to end up making a comment here is that since we don't know your investment objectives, I have no way of knowing which of the strategies we're going to end up talking is right for you. Only you can end up making that decision. What we're going to be doing, okay, with the whole covered class stuff, I'm going to kind of go through today, you know, what the covered calls are. I'm going to end up showing you a bunch of different research, different ways to end up writing things. And then what we're going to be doing is we're going to be doing a 4-week class. We're going to be doing 2 classes per week at noon on Mondays and Wednesdays. And we'll end up going through all of the specifics that you see today with a lot of detail on how to end up finding candidates, how you should be writing things to match your objectives. The price of the class is $375. We are going to end up giving any of our members who sign up in the next 24 hours a $50 discount, and that's the nice short URL that Tom has put together. Tom, any comments you want to make about that before I get started?
No, it's pretty self-explanatory. We've got the same slide at the end, so you don't have to write it down. You'll see it again later.
Okay. You know, in the disclaimer, I talked about objectives. So this is, you know, I always like to end up starting any class like this so that you're picking the right things for you. When you're looking at any possible investment, you need to determine what's an acceptable level of risk for you and set realistic expectations. You know, everybody starts with, well, I don't want to ever lose any money ever, and I want to end up doing, you know, 100% a year. Well, me too. When you find it, let me know, okay? I mean, they don't exist. So how do you end up finding the right level of return for the level of risk? Well, the way institutional guys measure risk-adjusted returns is that they take a look at what the periodic, you know, whether you're looking at monthly or annual, but what, or some people measure it even daily, but what the periodic returns are divided by the risk. Okay, and we're going to get in how they end up measuring risks. And what they end up taking a look at, many times you'll see institutional investors choose something that has an average of a, you know, an 8% return over something that has an average of a 20% return because the 20% returns has too many drawdowns. And what happens is some investors just can't stomach those drawdowns. how much can you stomach? Well, that's up to you. That's, your financial situation, how much of your capital you're putting in it, what percentage of your net worth is in something, and quite frankly, where you are in your investment life. You can afford to take a lot more risks very early on. Once you don't have any more income, you have to end up looking at things a little bit different. And that's a very important thing to understand how your returns will vary. Variance is a mathematical return word, and we're going to end up taking a look at some mathematical calculations on what variance of returns mean. Volatility, maybe one of the most overused words in the options world or in the investing world. When we talk about volatility, or you see volatility on a lot of studies, and we're going to share some CBOE studies and Goldman Sachs studies with you. I have some studies also done from Merrill Lynch. I'm going to end up showing you, and when they talk about volatility, what they're basically talking about is that they'll look at a stream of returns, usually monthly, and then they'll take a standard deviation, a mathematical standard deviation. For those of you who don't end up knowing a lot about standard deviation, this is your typical bell curve, where they end up measuring how many times you did 0%, plus 1%, plus 2%, plus 3%, and the same thing going to the left, minus 1%, minus 2%. And the returns tend to end up being gathered towards the center, and as you go further, either above or below, okay, the center point, you have fewer and fewer occurrence of those. Some people will call that historical, okay, volatility. And you'll hear things about what that bell curve looks like. If it's a perfect bell curve type of a distribution of returns, that's a normal distribution. What happens in investing, what scares so many people, is that we have what professional traders would call tail risk. Tail risks are things like 2008, okay, where the market can end up going down much faster than it can go up. Well, maybe not today, okay, with the market up over 300 points or so and the Dow. But in general, you'll normally see on average the magnitude of the severe moves down will end up being much, much larger than the severe moves up in the market. And that downward risk we call tail risk. And what ends up happening is that you'll see that those outliers will show a very large variance in the amount of returns that we can end up seeing. And, I remember we used to end up calling it the statement roller coaster. I remember one old commercial. This was back during the dot-com bust. The mailman comes with the guy's brokerage statement, and he goes to hand it to him, and he shakes his head, and the mailman goes to give it to him, and he runs away, and the rest of the commercial was the mailman chasing him, like all the way up a tree, trying to give him a statement because he didn't want to end up seeing it because he knew about the roller coaster. I ended up talking about, well, if those types of variances bother you, and they do bother most people, and they definitely bother institutional investors. So the way the institutional investors look at risk is that they'll take a look at those annualized, okay, return streams, or monthly, or however they're calculating them, and then they'll divide them by the historical volatility or the standard deviation of the moves. Now remember what a standard deviation is. All it means is about 2/3 of the time, you won't move more or less than this. So if I have a standard deviation of the S&P 500, and you'll see that in some of the studies we go, depending on the time frame, maybe it's 16. Okay, so what that'll say is that 2/3 of the time, the market won't move up or down more than 16%. So if you have an annual average return of, say, 8%, but you have a standard deviation of 16, that means your Sharpe ratio is 0.5 or a half. It's a very simple way, okay, to be able to take a look at what something has risks. Now, I know some people are saying, yes, but that's counting the overperformance, and you can actually have a Sharpe ratio that gets hurt if you have a couple of blowout months to the upside. Yeah, I know that's true, and they'll talk about Sortino ratios and stuff. But just to keep it simple, okay, most folks will end up looking at a Sharpe ratio. And I wanted to kind of start with this so that you understand, okay, risk and what's right for you. One of the most, I'm going to not say misunderstood, but just one of the biggest unknowns for people that have how much this can affect your portfolio is understanding this variance of return and what it ends up meaning to you at what stage you are as an investor. You know, when you're in the saving stage during your investment years, you know, I'm sure you've all heard about dollar cost averaging, putting in the same amount of money every single month. You know, you save your $500 per month every single month. Okay, I'm going. Now, in this case, when you're at this stage, volatility is great. Why? Because if the market gets cut in half and you're still sending in your $500 per month, yeah, you lost some money on the first ones, but now you're buying twice as many shares because it's kind of like the market's having a half off sale for you. Then you get the compound interest effect over time, and this just works wonders. So, you know, for the, 21-year-olds out there, or, your kids, absolutely the greatest thing to get them starting to save as early as possible, same amount of money. Volatility is a fantastic thing. Unfortunately, as great as volatility works for you when money's going into your account, when the opposite happens, meaning money's coming out of your account when you're in your distribution years or your retirement stage, it's the exact opposite. Volatility, okay, or variance of return is destructive towards your wealth because now when the market goes down, you have to take out by 50%. Now you have to sell twice as many shares to get that same monthly income. So this is really, a terrible thing for you to have volatile returns, okay, in your retirement stage. And really what you want to end up looking for, and it's very important for you to end up taking a look at, how do you end up looking at investments that have lower volatility? Because lower volatility means that it's going to be a much more consistent for you. Okay, so I just wanted to kind of go over this because while I don't know what, your level of risk tolerance is and what's right for you, I can guarantee you that, any investment advisor you end up going to is going to end up giving you a set of questions and things and help you to try to end up doing this. But their main goal was not actually to try to end up helping you. It was trying to make sure that they didn't have any SEC violations, or in case you sue them later on, okay, they say, well, we did all of these things and they were approved. You need to determine your level of risk and the level of variance that you can end up tolerating. I put this together some time ago for those of you who had seen me speak in different places, maybe in New York or in Arizona over the last few years. I really like for people to end up understanding this. So, I have 5 scenarios here. The top scenario is that, if I take a look at the average of the returns, they average 2% straight across the board. So, okay, that makes sense. 5 years, I'm up 10%. Yeah, I probably have a little compounding stuff going on, but I don't know how much that is. Second line is 4% averaging. Remember, these are the average. I just added up the numbers and I averaged them. This is an annualized return. So, in the last one, yeah, there was a lot of volatility, but we averaged 12%. Sounds great. So if I'm averaging 12% over a 5-year period, that should be 60%, right? No, because remember, when you end up losing 50%, oops, sorry about that. When you lose 50% down here, you have to double your money just to get back to even. So what ends up happening, and when I show you the realized returns, the actual amount that you would end up having, the first one kind of makes sense, right? Because if it's 2%, I'm going to end up getting a little bit of compounding interest going for me. But look at this. Over here, I ended up having an average of 4%, returned 21%. Here I averaged 12% because I had a really, really big drawdown. My realized return was actually lower than it was if I had 1/3 the average performance. So when you take a look at this, and you have to realize that when people are selling stuff to you, they're trying to end up looking this in the best light, and there are all of these rules about what they have to show you and what they don't have to end up showing you, but you really have to kind of understand things end up how they work. and you don't want to end up getting hit with something, way below your expectations. Mark Twain once said, there are three types of lies. There's lies, damn lies, and statistics. Okay, so, know your risks. What we're going to end up doing from this point forward is that I want to go over a couple of, actually I'm going to go over three different covered call research papers. They're going to go through and they're going to talk about how they end up doing the research, what they end up doing. The first one is the CBOE and the Standard & Poor's Company put out a study for all of these different types of covered call strategies that they have on the index. You can download the slides. Okay, so the link will be available. You can just download the paper. I've put the link right there. The other two, or actually the other three studies, because one of them's just broken into two parts, Goldman Sachs did a report about 5 years ago, okay, on how to end up turning, okay, your stock portfolio into a bond portfolio in terms of risk, with actually less risk than bonds and greater yield than bonds. And what they've been doing is maybe twice a year, they end up doing an update and they end up showing the updated statistics. So we're going to go over the original study and I'll show you some of the updated statistics on it. And then the last one, to me, which is probably the most interesting. They had done a 16-year study on just pure covered calls. And they're going to end up showing you what some of those findings were. And I can tell you, if you're like me, you're going to be shocked by some of the stuff that they ended up doing. I'm going to start with the CBOE paper. The CBOE has a bunch of different indexes. And here I listed some of the more common ones that they end up using. They have an S&P 500, what are known as a buy right, okay? And it's just a term where they're buying the underlying, meaning they're buying the S&P 500, and they're writing a covered call at the money, it's ATM, every single month. Okay, and that's a BXM is the symbol for that. They have another one where they buy the underlying and they sell a covered call, but this time they do it 2% above the current price whenever they end up writing it. And they do it every single month, right? They just keep rolling it and rolling it. They have another one called collar, where they're selling a covered call above the money and they're buying a put below the money. This way you're protected in case it goes down, right? That's what everybody always ends up wanting. They have another one where they're just for the cash-secured put sellers in you, they end up writing puts below the money every single month. And then they also do it. They do similar ones for the NASDAQ, the Russell, and the Dow. Again, you can download this. I've given you all of the links in case you want to end up reading the papers. They also had come out with a white paper about a year and a half ago on the difference between the strategies. Okay, and I kind of wanted to end up going over this because this I thought was really interesting. We're only going to talk about the top four because the other ones, they have like VIX option stuff on things, and I think that's just beyond the scope of where we're going to end up getting to today. But those are the four that we just talked about, right? The writing, the covered calls, and here's some of the specifics. And it kind of ends up explaining, when you end up having a covered call and you're writing it at the money, it cushions against a decline, okay, in the market going down because you're receiving that really nice premium, right? You're getting the most extrinsic value of any of the calls when you write them at the money. And so that gives you a bit of a cushion if the market goes down, but it really truncates performance if we go up. And so they kind of end up doing the real brief explanation about what each one of them is. Here is the distribution of this 7-year study from January of 2006 to December of 2012, and it shows you the distributions of positive months and negative months. It shows you the distributions of the number of months that was greater than 10%, and those that were less than 10%. And you can end up seeing things like selling the puts is going to end up giving you the best percentage returns. However, every once in a while when the market really, really tanks, you're going to get hurt, okay, by more than 10% in a single month. If you go and you buy the collar, right? You're selling the covered call and buy the puts. Well, then you're never going to have a 10% loss in a single month. Why? Because you own a put. But you're going to lose. Your winning percentage is going to end up being the lowest of anything else. This is what I meant when I said understand the trade-offs. So here are some statistics about what they end up the results. The first one is the average or the mean, and TR stands for S&P total return. That means that they reinvested the dividend. If you look at, it's the difference between the SPY price and the SPX price, right? The SPX price ends up having the dividend reinvested in it all the time. So that's basically what they're calculating here is the SPX. The SPY was the 2% above the money, okay, covered call. The SPX was the at the money. The selling the put ended up having the highest, okay, mean return. And here was the collar, which had the lowest. Now, here's interesting. While it had the highest mean return, okay, when you take a look at the median, that means how many months were above and below it, you can end up seeing that it ended up actually having a lower return selling the put, even though it had more, its average was higher, its median return was lower. And so when you take a look at the average annualized standard deviation, this is just historical volatility, you can see that during this 7-year period, the market, the S&P 500 as a whole, was just under 19%. You can see by doing things like selling a covered call above the money, you can cut its volatility. You cut its volatility even more if you sell the covered call at the money. If you use the put, because the premium's a little bit higher, it's even better. And then if you do the collar, okay, you have the best standard deviation. Why? Because when you go down, that put's going to end up helping you, right? The only problem is that it really makes a big difference. The thing that I like about this study, the thing that I like most about this study is that they actually broke down standard deviations into down months and up months, okay? So when you take a look at this, as you would suspect, the standard deviation, if I only look at the down months, not the up months, only the down months, the standard deviation is almost 2 points, right, about 1.84 higher for the negative standard deviation months than it is on the positive months for the standard deviation. So when I go and I take a look at this, if I write the covered call above the money, it's what, maybe 0.1% closer? Look at the covered call. The covered call is less than a point. Matter of fact, it's about 0.8. So they really have a much, much closer standard deviation between the up months and the down months. But the problem is, look at what happened. You have a 0.05 average return. Okay, you gave away almost all of your return for buying that protection. What does this end up telling you? Okay, if I was to look at a collar, and by the way, when we go through the details of this, so you download it, you'll end up seeing that the way they end up doing the collar is not symmetrical. Okay, most people look at symmetrical collars. What do I mean by a symmetrical collar? If I sell a 5% above the money, above the current stock price, if I sell a 5% above the money call, and I use that money to buy a 5% below the money put, in most indexes, almost all index and equity indexes, that put is going to be significantly higher. Okay, the difference between the cost of those, okay, is measured by a measurement of skew. A little bit different than the skew they're talking about here. But since those puts are normally more expensive, just buying the put sometimes doesn't end up giving you the best mathematical advantage. And while I'm on mathematical advantages, I want to end up talking about one thing here, and that is some people I know love the strategy to go and sell puts on the indexes, and they will oversell their puts, meaning that they're going to sell a lot more than if they got assigned, and they could end up having the money to go and buy those puts. And I would end up saying, I'd caution against getting too aggressive doing something like that. Now, if I was to run a 100,000 instances in a Monte Carlo simulation, right? Take 100,000, samples, and just run it, and sell naked puts below the money and just max it to the hilt, right, as much as I can. I am guaranteed, well, as close as you can be, right? The SEC never lets you guarantee anything. But I am basically guaranteed to make money on those puts if I had 100,000, simulations that I could run. Here's the problem with studies like that, 100,000 months means that you have to live for more than, 8,300 years, okay? I don't think anybody here has an 8,000-year lifespan. So the problem is that if one of those losses happens after, say, month 24 or after month 12, I can pretty much assure you you're going to have a life-altering experience. So if you get into those higher risk scenarios, just realize that we talked about the fat tail distributions, meaning that there were more down months than up months. This is what you need to be careful of, okay? I wanted to show you a return graph of the three most popular ones that we were talking about. The black line, as you can see here, everything goes back to 2005. The black line starts with the S&P 500. And you can see what happened in 2008 and how we've come back from it. The blue line, the gold-colored line or brown-colored line was the first of the CBOE indexes to be published. And that was writing the covered call at the money. As you can see, when the market goes straight up, this is going to underperform. When the market goes down, you'll end up catching, a lot of extra premium, and it'll help to offset some of the loss. Now remember, you incur 100% of any down move minus the money that you get for the covered call every month because you're writing it at the money. The best performing, strategy here is writing the covered call 2% above the money. You can see here that it actually came in later, so its starting point, it is right in this graph, actually had to give the S&P about a 10% head start. It not only caught up by, it's still above it, even though it started later. Further on, they start at the collar, and you can see that, the collar looked absolutely great, when the market is tanking. But over the long run, especially in up markets, the collar just really, really underperforms. I've kind of been talking about these things, so I wanted to end up just spending a couple of minutes for those of you who aren't real sure about, how the covered calls work, and I'm just going to spend just a couple of minutes doing an overview. If you buy 100 shares of stock XYZ and it's trading at $100, you're what we end up calling a dollar for dollar investor, right? Market goes up $1, you make $1 a share. Market goes down $1, you lose $1 a share. By the way, so the slope of that line from lower left to upper right is a 45-degree angle, and the slope of the line, if you guys remember, high school algebra, mx plus b equals y. The slope of the line being m is 1. By the way, you options traders, if you own a share of stock, slope of your line or your delta is 1. They're basically the same thing. So what happens if you want to end up having protection on the downside? They're called married puts or protective puts on the side. And if I take a look at how much something like that would cost, if I went out and I wanted to end up buying on a reasonably volatile stock out a month or two, maybe I might pay $2 for protection below 95. It almost works like if you want to think of it as collision insurance on your car or your house insurance. What's your deductible? In this case, we have a $5 deductible, right? Stock price is 100. I'm buying a 95 put. I'm paying $2 for it. So that means that no matter what happens, okay, in my $100 stock, it can go to zero. I can never lose less than $5 because I had a $5 deductible plus the $2 that I paid for the protection, right? I can never lose more than $7 no matter what happens. The problem is that if we finish any place above 95, I'm giving up $2 of my performance each and every month that I don't cash in insurance. That insurance goes to waste, and I've wasted my $2. Some people say, you know what, I love the concept, but I don't want to really end up paying for it. The concept of a covered call is that if I did the same thing, say $5 above the money, and I sold the 105 call, I might receive something like $1.75. And this is kind of generous. This is more of a equity, more of a single stock. If I was doing this on an index, if my ratio might end up being closer to, well, at least closer to or approaching 2 to 1, meaning I probably would only receive maybe $1.10 or $1.25. When things get really ugly in terms of how expensive the puts end up getting compared to the calls, it can get even above a 2 to 1 ratio. The S&P at one point last year was actually approaching 3 when you looked at a certain percentages above and below the money. So what ends up happening is that a lot of people saying, hey, why don't I put them together? I'll sell the covered calls, I'll give up some of my upside protection, and I'll end up buying the downside protection, and this we call a collar. Okay, where we're basically collaring the stock, where my price is never going to be, I'm never going to participate in anything above 105, and I'm never going to have to endure the pain of going below 195. So when we take a look at the papers that the CBOE published, they did a covered call on the indexes every month, 2%. So they did like a 102 call. They did a covered call at the money, so they did like a 100 call. And then they also ended up doing a collar. And their collar, by the way, was 10% above, 5% below. So it was a little bit skewed. Okay, so that's just basically, I want to do a quick overview. I had put this up. Okay, and Tom will end up getting this someplace, I know. It'll be a part of the presentation. We'll probably end up putting it as a cheat sheet for you. But it was a cheat sheet that I used to end up keeping, right? I'd always saying, well, which one's a call, which one's a put? How do I end up, figuring them out? And I always just remembered cup. My call equals the underlying plus the put. So I can substitute. If I just purely buy a $105 call, I buy a $105 call, that would almost be the same. Actually, it would give me the exact risk-reward graph of buying the stock and also buying a $105 put. Now, once you end up remembering cup, like I do, it's just, you do the algebra, throw stuff on one side or the other, and you can figure out what any substitute for a long call, short call, or a put or the underlying is. Okay, and I also put the names there, okay, so that if you ever hear people talk about synthetic, long stock, okay, or synthetically short stock, for example, it's synthetically short stock, okay, where I'm going to sell a call and buy a put at the same strike, okay. Some people call that a risk reversal. Some people call it a risk reversal, but there it is in case any of you guys want to have it. I'm going to go over, 2 Goldman Sachs reports that I thought were very, very interesting in and around covered call. I had just a ton of research in it. The first one was written about 5 years ago, and they give an update about every 6 months. So I'm going to end up going over the report, and then I'll give you the latest update that came out in July of last year. What they ended up showing here is that if they do one of those risk reversals, right, over here, where they're basically, what they would do is that they would buy the stock and then they would put on a synthetic short where they would sell the call and use the money to end up buying the put for it. But instead of actually buying the puts, they bought a put spread, a really wide put spread. Why? Because selling those puts very far below the money with a very high implied volatility meant that they could end up getting a much better return. So that's what they ended up doing. Now, here was the most fascinating thing, and this one kind of like really, really took me. What you're looking in the first graph here, this is the median return. You're looking at the bar of the candle, if you will. You're looking at the 75th percentile and the 25th percentile, okay? So that means that half of all of the returns are in the body of the candle. Then what they're showing you is that the bars at the very end are the 95 percentile and the 5 percentile, okay? So that's between the stubs at the very end of the candle wicks, if you will. That's 90%. Okay, so by the way, they were just looking at standard deviations, right? 95%, they were just saying, here are the returns of 2 standard deviations. Okay, now the first one, as you can see here, this is the distribution of returns of bonds. This is the distribution returns of their put spread collars, their options, right, where they put on that risk reversal with a put spread. They collected the dividend. They ended up doing it so they got a little bit of money from the spreads, right, because they wanted the option to actually make them money. They didn't want it to cost them money, and so they ended up doing it so that they just captured a little tiny bit of yield. And the study went into how much yield per year they should capture, and they went through a whole big study on it, and I'll explain to you in a second. And then the last one, as you might expect, is just the stock by itself. Now take a look at the stock by itself. It actually has the highest average return. You can see that over here, right? Look at where the return is, right? You made much, much more money just owning the stocks. Okay, and by the way the study was done is that they took every stock in the S&P 500 and then they filtered them out, so they only did the more liquid stocks with options that they could end up doing for the entire study. What they ended up showing during the study was that you got much better returns in the stocks, but your volatility was huge. So if we go and take a look at that institutional view of risk-adjusted returns, and we take a look at the Sharpe ratios, where all we're doing is that we're taking a look at what their returns are divided by their volatility, the stocks had such high volatility that during this period, now this period included the dot-com bust and the 2008 financial crisis, okay, stocks actually had the lowest Sharpe ratio. Bonds had a higher Sharpe ratio, and writing these calls, okay, and using them to buy put protection to end up lowering your volatility actually produced the highest Sharpe ratio. Okay, yeah. So really interesting. Here's their chart. You know, I showed you some previous charts. You know, the black line is just the stock. That's the dollar for dollar investor. I showed you if you put on a call above the money and a put below the money, that's what they're calling buying a call. It would be a collar, but because they're selling this, if you will, this naked put maybe 40% below the money, okay, or I'm sorry, 35% below the money, they're showing this in terms of here are the risk-reward curves. So if I buy and sell the same strike right at the money, here's what my risk-reward curve looks like. So I'm going to end up generating yield every single time I sell the options, whatever period that is, if it's monthly, quarterly, you know, whatever time frame I choose. And I'm going to end up making the same amount of money unless I go and lose more than 35% of the stock. If I split the strikes, so if I say write the covered call 5% below the money and buy the put 5% below the money, that's the darker blue line here. You can see that, you know, the way they set it up was that even if I had that pullback, I wasn't going to end up losing money. And if the stock goes up, I make a little bit more. In the study that they showed you on the first page, it's the black line that they were showing you, right? That's the most conservative. And then if you wanted to be a little bit more aggressive, you ended up liking the stock, instead of, say, using 5% below the money and 5% above the money, they did 10%. So the lighter blue line, which is this one right here, they ended up selling the covered call 5% below them. I'm sorry, 10% above the money. They sold the covered call, and they bought the put protection 10% below the money. And every single time, because of the way those puts get more and more expensive in terms of their implied volatility as you go below the money, they were always selling them. Why? Because the thing is, it helped their risk-adjusted returns. Okay. Here's a very interesting chart. It shows the yield, okay, of the market, okay, of the S&P 500 stocks. If I was to look at just the yield of the S&P 500 dividends, okay, that's the light blue line, okay. The blue line shows you what your yield would have been if you would have done, okay, their conservative strategy in addition to the yield. Now, remember, these are returns, so that when implied volatility skyrockets like it did during the third quarter of 2008, the amount that they're getting, because they're actually receiving, okay, because they're selling those puts, is absolutely huge. So what they're doing is that they are taking, a little bit more risk, meaning what happens if the stock goes down 35%? If the stock goes down 35%, probably the bond prices are getting hit also. But it shows you how much you can end up increasing your yield. When I told you they're taking a little bit of risk, what I really liked about this report also is that here's a graph of showing you where that risk is. Now, here is the value when they started the study of the stock, which is the light blue line, the bond being the darker blue line with a triangle, and then the stock with the option, with that covered put spread, okay, or that collared put spread, selling the covered call at the money, buying the put at the money, and then selling a put 35% below. What's very interesting is that when the stocks move up, obviously nothing's going to beat the stock. But when the stocks get hit, okay, you can see the stocks will get really, really hit. Now remember, because you have on that put spread, for the first 35% down, this is the best alternative. It's not until the stocks start to get in real jeopardy, okay, and this is the stock, by the way, this is the stock going out of business, okay, and then just the bondholders own the stock. You can end up seeing, okay, what happens is that the stocks are going to ones take the worst hit, and at some point, the bonds will actually perform better, somewhere around 45% down. Okay, is where they'll start to end up performing better. And then over here, if you go to the left, this is default, and this is default with the bond value guys getting zero. So they took this below zero in the terms of the price of the stock. They took it to the bonds being zero, and it showed you what the P&L ended up looking like. So, I mean, a very comprehensive report on understanding your risk, and I really like this because, most of us only think between zero and where the stock currently is, and it kind of ends up giving you a good feel, right, for what type of risk that you would be taking. The last report, this is the report that they ended up publishing most recently on what they ended up calling the bond buyer's equity basket, right? That was the whole program. Here was an interesting part of the study where they actually showed here's the yield on AAA corporate debt, and here's the yield on the S&P 500 dividend yield. You can see that you used to end up being rewarded, okay, for taking on bonds, but interest rates have come down so far that there isn't a big difference, Does this options program make sense in 1996 when you're basically getting an extra 5 points of yield for the bond versus the equity? Probably not. Does it make sense if they're anywhere close? Without question, yes. Okay, so you can end up seeing here what the yields look like, okay, compared to the two. One of the things I want to point out here is that bonds have interest rate risk, meaning that if the yields go up, the value of the bonds, especially the longer term ones, will end up losing value. Okay, the longer the bond, the longer the duration, the longer the time that it matures, the more you have risk when interest rates go up. So when you take a look at the option strategy now, okay, writing options, okay, and keeping the yield versus bonds, where we're already starting to see in the Fed futures rates where they're looking at raising rates, um, you know, during the second half of the year is what the bond futures are predicting right now. Um, this is a bit scary, okay, for bondholders. Um, you realize that there are some people in this industry that have never seen a rate hike. I mean, I know most of you haven't, but you take a look at some of the kids that work in these institutions, and if they only have 8 years of experience, they've never seen a Fed rate hike in their life. Right, the last time we had a rate hike was in 2006, 2007 timeframe. So it's been a long time. Okay, we even almost went in at least in theory, below zero, because once the Fed funds rate got down to zero and they were purchasing their own debt, they were taking things off. You almost effectively had negative real savings rates. And while we're done with our quantitative easing, Japan's just getting going. I mean, they got both burners going on their QE program. They make ours look, like child's play. The ECB is also in the process of trying to end up doing things. So it's going to be a while. What has all of this happened in the market? What happens in the market is that when you take a look at some mutual funds and you take a look at your straight bond funds, okay, plus you take a look at these hybrid type of funds, where they're doing different things to try to end up increasing yield. And you can see that the flow of these types of hybrids has grown from, less than 10% 5 years ago to, we're in the 40 to 45% range today. So people are searching for yield, and they're looking at different ways of doing it. And this covered calls, okay, they actually talk about as being their favorite alternative. Why? They did a 16-year study on putting covered calls on. Now, what institutional people call is, it's called an overlay strategy, right? Because you own the stock and then you overlay an option strategy on it. And because some people used to call it writing a call, because the thing is you actually would write up a ticket, okay, to put your covered call on. You would be writing your covered call over your stock. So obviously an institutional guy wrote this because they called it overwriting observations, a 16-year study. And they go through, okay, what were the 7 factors? There are only 4 right here because that's where the majority of them. But with but just adhering to 4 factors, what they end up doing is, again, took the S&P 500 stocks, those that had enough liquidity to end up writing the bonds during the entire time, and here was the return of the individual stocks versus writing a covered call 10% above the money every single month, 1 month out. Interesting. I can also tell it's an institutional guy because he didn't say 5.39%. He said 539 basis points, which means the same thing. So it's an institutional report, but even though it's an institutional report, I thought it was really interesting to be able to share with you. I mean, that's some significant outperformance over that time frame. Um, I wanted to kind of just cover, okay, you can't go over the whole study. I mean, it's way, way too long. But what they ended up doing is that they took their benchmarks. Oh, by the way, take a look at these. Same things that the S&P ended up having with CBOE, right? They showed benchmarks on writing them on the S&P 500, the NASDAQ, the Russell 1000 Value Index, and the Russell 1000 Growth Index. They ended up writing, they showed performance by writing in market conditions, in rising markets, in lower markets. They taken out liquidity. And while they didn't put in transaction costs, they did end up buying everything on the bid and selling everything on the ask. Kind of saying, hey, you know what, we've made some allowances for it. And they've also talked about, you know, when they started this in 1996, options volume has grown sixfold, okay, by 2012. I told you there were 7 factors that they looked at. Okay, first of all, they took a look and saying where they ended up writing the covered calls. In the study, they chose 10% above the money. What they ended up doing, and this is kind of interesting, I know that a lot of our audience looks for options plays, and what they do is that they love to sell puts and calls, okay, way, way out of the money, sometimes naked, on earnings. What this study ended up showing was that they actually lost money selling covered calls on a consistent basis over the 16-year life cycle. They lost money. I want to share one story here. I have a good friend. I won't end up saying his name, but he had the unbelievably good fortune after graduating from Yale, his second job, he went to this little tiny startup, okay, that was hoping to become an internet provider called AOL. After retiring after the IPO and cashing in all of his shares, he ended up working for another little startup. I don't know if you guys remember, but At Home or Excite at Home. He was one of the initial guys in there, and they went public. And so at the ripe old age of 32, he retired. And he had started his career, by the way, with one of the largest options trading firms on the floor of the CBOE. And so he ends up retiring, and he thought that selling covered calls on these high-flying stocks where you just had huge premium. Look at how much money I get. Okay, if I sell this covered call 40% above the money, I can't get hurt. There was a Research in Motion, RIM, earnings report that blew out his entire trading account and took a chunk of his AOL stock. It was horrible for him, okay? Be very careful. All you have to have is one of those things. You could make money for 5, 10 years and then have one of these instances, okay, just blow you up. So what they found was that, you know, those fat tails were big enough that they just didn't write options in earnings months. The returns were better. What they found was that more liquid, larger cap stocks were better than smaller caps. Kind of interesting. I would end up saying, yeah, that kind of made sense. To end up overwriting stocks with higher implied volatility. Overwriting is just their term. It just meant that to avoid the low volatility stocks, right? The problem is that you don't get any money for them. So it's not even worth it. But here's an interesting thing. Avoid writing stocks that have strong momentum. So this is almost the conflict of the one before, right? Because the thing is, if the stocks have really strong upward, okay, movement, and there's a lot of stocks that end up doing that. You think of, I don't know, like the Teslas or the Twitters, okay, or the Facebooks of the world. When they move up, they might, you know, take that call and curtail your performance and truncate your performance if you move higher. So they ended up avoiding those. The other thing, okay, but by the way, one quick comment here. I know some folks who used to end up looking for generating lists for doing covered calls. And I remember, and I had tried some of this, and I ran some back tests on looking at things like, let's say, the Investors Business Daily 100, or now it's only the 50, but the IBD 50, right? Terrible, terrible candidates. Why? Because they tend to end up being of all cap, including small cap, and they're the stocks that usually have the highest momentum. So the problem is that if it's up 10%, okay, and then down 10%, and you wrote your covered call someplace, or if it's up 20% one month and down 20% the next, and you wrote your call 10% above the money, you got truncated and you only got 10% of the 20. But when it went down, you got all 20% of the pullback. So that's why those super volatile stocks in terms of that have strong momentum, you have to be a little bit careful. The other thing that they ended up finding was that you should look at stocks with moderate dividend yields. I know some people who like to write covered calls on the super high dividends. The challenge is that if their dividends are too high and their payout ratios to be able to pay those dividends are too high, the dividend's already coming out, the way they calculate the price of the calls, the dividend's already coming out of the call, so it's not even included in there, and so you're banking on it, and so they tended not to end up being very good. The last one was that defensive type sectors, okay, not the high flyers, this goes back to momentum, were better candidates. Matter of fact, every industry was better except for energy. Okay. Here's some of the details of what went on. It was, here was something that I found just really interesting. Do you guys remember Bill Visconto from EAB was on a few weeks ago, and what he does is he builds hedges for institutions. And you remember when he ended up saying he only writes things in terms of percentages out of the money. He never uses delta. And, all of us options traders saying, blasphemy. How could an options trader look at things as percentages and not use deltas? Here's a pretty interesting thing. Take a look at where they kind of did things and tried to make them consistent. They took a look at something that was 0% out of the money, which was a 50 delta. They took a look at something that was 2% above the money, which was close to a 40 delta. Now remember, the deltas will end up having a varying distance from the money depending on how implied volatility is. So what Bill and his ex-Goldman partners had found out, okay, long before this, was that when implied volatility is extremely high and you're writing, let's say, a 10% out of the money or a 30 delta call, as the implied volatility gets higher, if you're using deltas, you're pushing your options further away from the money, and you're not collecting as much money. Now think about that. When volatility is super high, you probably want to be collecting more of it. You shouldn't be pushing it way, way out of it. And so you can see the difference in terms of their average returns and their standard deviations. Remember, this is all of the stocks in the 16-year study. You can take a look at their Sharpe ratios. And so the reason why they chose 10% out of the money and not 30 deltas or any other deltas is that it gave them the best return for the risk, or the highest Sharpe. When you looked at, I said energy before, I meant materials, okay? When you take a look at the different industry groups, okay, the more defensive ones ended up having the highest Sharpe ratios. Only materials, and think about that. Think about like gold miners, for example. Think about how incredibly volatile they are. So when they go up, they can go up just an enormous amount, and the covered call can end up truncating that performance. Okay. They also end up going through different markets. When is it better to end up writing? Okay. Do you end up, here's the thing, do you end up writing calls on companies that are doing well or doing poorly? Many, many times, okay, I've heard people saying, well, the stock has gone up so much, this is a great time for me to end up writing a call. Well, guess what? Actually, it was the stocks that underperformed the S&P by 3%, which were the greatest covered call writers, which makes sense when you really think about it, right? Because when a stock goes down, the implied volatility is higher, the vol skew gets a little bit flatter, so you're going to be collecting more money for that call. Yes, it might bounce up, and yes, it may rip through you, but on average, if you do this on a consistent basis, it's usually a very, very good thing to end up doing. Last thing I just wanted to pointing out here on this chart was that the dividend yields between 1% and 4%, current yield 1% and 4%, were the ones that also ended up giving them the best returns. I wanted to show you this as the last slide of the study because I thought this was the one that was most interesting. What you're looking at is their annualized returns on the left versus their annualized standard deviations. So when I take a look at where the 50 delta is compared to the 0% or at the money, where the 40 delta was in terms of its standard deviation, right? It had almost as good as return as the 2%, but a much higher standard deviation. And so what did they pick? They picked writing the 10% out of the money. That's what ended up making the most sense. And by the way, owning the stock by itself, okay, did end up giving you a reasonable return, but look at how high the standard deviation was. So what we're going to be doing, by the way, this is just the performance chart, okay, going out over the years. You can end up seeing that. So what we're going to be doing, okay, in the 4-week class is we're going to basically break down, okay, that report. We're going to end up showing you how they ended up looking at stocks, how they what they ended up using. They love stocks with strong cash flow. They were looking at their recommended list and which stocks they would use and which ones they didn't. We're going to go through how to end up picking candidates. We're going to go through and taking a look at implied volatility and which option strategy to end up using for you, which one makes the most sense. Let me see if I have it over here. I just wanted to see if I could end up pulling up the agenda. Oh, no. I thought I had it. I don't. Anyway, we're going to go through the class, and we're going to end up showing you what makes the most sense in terms of which options to sell where, what the risk rewards are. What's right for, investor number one might be a terrible choice for investor two or vice versa. Some people are going to end up wanting to do those wider put spread collars. We'll show you how to end up doing that, what to end up taking a look at. We'll go through some details. We'll show you what yields look like, okay, in terms of all of the analysis that you'd end up doing. We're going to end up using option view to end up actually starting some trades and end up showing you what they are. We'll go through the details by industry group. We'll end up actually showing you some tools to do scans on finding good fundamental candidates. Then go and take a look at the ones with the strong upside momentum, taking a look at some of the technical analysis that they ended up including, and then finally some of the analytical or the options analysis. And when you're done with the class, you'll be able to end up writing your options in a strategy that suits your objectives. And we're going to end up getting started on Monday. Tom, I haven't been, because I only have one screen, I haven't been looking at any of the questions, and I know that I've been going just about an hour. Boy, there's a lot of chat in here. Tom, you there? Oh, we might have lost Tom. Okay, I'm just looking at some of the questions. Bob, yes, there will be a copy of the slides. When Tom posts it, he will put the slides up for you. You can end up getting it. There's also the URL of the CBOE white paper. I've been asked this before. I'm on a institutional list, so I am not allowed to end up sharing the actual Goldman Sachs report with you, the full report. I'm allowed to end up giving them credit and showing you exhibits in it like I did, but I am not, as long as I give them credit, which obviously I did, but I am not allowed to send you the whole report. There were some other things. Who manages the covers and calls, how to put on, okay, X, Y, Z, okay. Jerry, okay, that's what we're going to be talking about. Jerry just asked a whole bunch of questions about how the straddles are managed. Okay, I'll go over, okay, in the report of how they ended up managing theirs in their paper. We'll go through the trade-offs of how you can end up doing yours. Did the wash sales, okay, ended up affecting, okay. Kevin, what they ended up doing is that they didn't go through any wash sales because they ended up taking their options off. They did not include if stock got called away. So they were not included in any way on this. The slides will end up being, Tom ended up already mentioned that the slides are going to end up being in the library. So Sosnoff was right when he talked about 30 deltas. The answer is if you talk in deltas, yes, okay, without question. In that range is exactly where you should be looking. However, the challenge with deltas versus looking at percentages is, again, as I talked about, you don't collect enough money, okay, when the volatility is high because you're pushing your calls way out of the money. And that's why using a consistent percentage ended up actually yielding not only the highest returns, but actually much better Sharpe ratios. But yeah, Tom, no question about it. Sosnoff knows his stuff. I've already mentioned the questions about deltas. And yes, we're recording this. Tom will try to end up getting this thing up if he can tonight, so it'll be there tomorrow so you guys can download it, listen to it again, go through the slides. The courses, once the covered call class, we will be going through the classes, and if you sign up, they will be recorded. They'll be on the website. You'll end up owning them in terms of being able to download them and watch them whenever you end up wanting, if you end up missing anything. The class will end up being 4 weeks, so there'll be 8 classes. I'm going to try to cover your examples inside of those 8 classes. If I don't have time, we might have to leak out to a 3rd class in some weeks just to be able to end up handling, questions and your specific examples. Let me see if there's anything else here.
This one at the end about using covered puts as a tool to own shares at a lower price.
Without question. And Tom, I don't have the agenda. If you have the agenda, could you take the ball back and show them the agenda?
Yeah, let me...
It's the outline that I had given you. Yes, we're going to end up going over covered calls. We're going to be going over cash secured puts. We're going to be going over using diagonals. Instead of buying the stock, do you want to end up buying an option instead? How far out should that option? Do you even want to use leaps? We're going to be going over collars, okay, put spread collars. If there is any type of variation of a covered call, we're going to end up showing it to you. We're going to talk about the trade-offs. We're going to tell you how to end up doing your own analysis so you understand the trade-offs, so you can pick the right risk-reward ratio that suits, your investment profile. We're not going to tell you that this trade is, the best one for everybody. Just because something has a statistical advantage, the risk might still be too great for you to end up taking it yourself. So that's what we're going to end up going through, and I guess it's just a little bit higher, Tom, at the top of that page, right? This is the covered call, class, and there it is, right? The cash secured puts, married puts, okay, some people want to end up keeping all that upside potential, and they don't mind if it costs them a little bit of money. So we'll talk to you about it, how to end up doing it, and what the trade-offs will be. We'll take a look at using diagonals or leaps to make synthetic covered calls, the collars, okay, covered strangles, okay, and straddles. which are one of my favorite, because one of the things that we end up doing is that I'm going to end up showing you a strategy that been very, very popular and actually works incredibly well, where instead of doing just a covered call, okay, above the money, or a cash secured put below the money, you do half of each. Okay, and then you just keep rolling the trade, and I'll end up showing you a methodology so that you can end up always collecting premium on the covered calls, collecting premium on the stock, and if you're going to end up doing that, we'll also talk about the margin ramifications and the risk that you'll be taking. If you don't have cash secured put and you only have some of it, you can still do this and get a much higher yield. But the trade-off is that you have more risk, and we'll end up showing you how to calculate that risk. I will also take you through the fundamentals, right? The fundamental analysis, okay, that Goldman Sachs talked about in their report, along with some other things where you heard about them using more defensive industry type of stocks, not the high flyers. They talk about a lot of free cash flow. So I'll show you a tool how you can end up generating your own reports. I'm going to go through a couple of different tools. The tool that I'll end up showing you costs about $300 for every 2 years. It's from the American Association of Independent Investors, AAII. And the tool that I'm going to end up showing you how to end up doing this is Stock Investor Pro. During the class, I will end up generating these lists, and we'll end up generating the candidates for them, and you'll end up seeing how to end up going through the candidate list. What we'll also be doing during this time frame is that on Tuesday, LiveVol is going to end up having a representative come and speak to us on how to use their scanning tool. And one of their scanning tools is how to find higher yielding covered call candidates. Now, they make no they do no analysis whatsoever on, is it a good candidate from everything we talked about, right? Is it part of this industry or that industry? Is it a high flyer? What's the implied? All they're looking at is, hey, what's the yield on the covered call? But, you know, we can generate the lists on, are these good candidates, generate the list from LiveVol or OptionView, and show you how to end up doing the cross-matching to be able to find candidates that, you know, will best suit you. In the end, once you end up finding, you know, your set of candidates and you end up learning them, you'll always run your list to make sure that you're having your candidates are there, but you'll get to know your stocks. And you'll understand, you know, the type of movement it ends up having, and we'll tell you how to end up doing it. We'll also show you how to end up looking and choosing your strikes sometimes. We're going to go through technical analysis and what that ends up meaning and where you should be setting strikes. And then the last will end up being, we will use OptionView and LiveVol to be able to end up showing you how to end up calculating some of these things. The last comment that I end up making is that you know, if you are interested all in LiveVol, we ended up saying, you know, if you use our link, and because I've gotten a couple of emails on this, if you click on the link through Capital Discussions and then open up an account, they'll give you an extra nickel off of a contract. So if you sign up with IB, you pay 70 cents a contract. If you sign up with LiveVol, you pay 65. If you click on the link through Capital Discussions and open up an account, you'll pay 60. If you open up an account with any paid class of service, okay, through Capital Discussions, LiveVol, okay, we'll give you an extra nickel, so it'll bring your commission rate down to 55 cents. So if you're going to be doing covered calls, you know, between their tools and being able to save, you know, 15 cents off of the IB rate, you know, to me, you know, is a pretty good deal. And we're going to have their chief product developer come on Tuesday and show how to end up using some of their scanning tools. Tom, I'm a little bit over, but it was a lot of information.
It was, Jim. Appreciate it, and I'm looking forward to the class. We do have one scheduling conflict because Monday the 19th is Martin Luther King Day, so that week I think we'll have class on Tuesday and Wednesday instead of Monday and Wednesday. But other than that, the other Mondays are fine.
Okay, and I'm pretty flexible. If people would like that, we can do that. Or if they just want us to go one extra week because they've made arrangements for Mondays and Wednesdays, we can end up doing that. But whatever, if there's a difference between what class members want, we'll end up accommodating whatever we can. Plus, we record everything. So if they can't end up seeing it live on Tuesday, they can always watch the recording.
Well, we could do it on Tuesday or on Monday, so we could just ask the class what they want to do. And Thomas, they're at noon Eastern on Monday and Wednesday.
Tom, I miss any other questions?
I think that's it, Jim. So appreciate everybody coming, and look forward to the class on Monday. Next Thursday, Jerry is coming to talk about technical analysis with options, so look forward to that. And the trading groups are going great, lots of participation, market analysis on Monday, so there's a lot going on, so we hope everybody can join us with these meetings or watch the recordings if they can't attend live.
Tom, thank you very much. Have a good evening, everyone.
All right, thanks, everyone.